My guest for this show, the first episode of what I think I'm going to call the Not Unprofessional podcast, is Don Mango. Don, welcome back.
Thank you, David.
So the structure for today is we're going to read through some cases, and we're going to talk about how they apply to the precepts of the Actuarial Code of Conduct. First case. This is taken from an email newsletter of Matt Levine describing the insanity that is Bitcoin. I'll read out a little blurb here from Matt, and we can talk a little bit about how this would be treated were you an actuary in this situation. So, in a quote, "It is hard to believe that anyone commits securities fraud anymore. Right now, you can design an electronic token, such as Bitcoin, say in big, bold letters that the token is utterly useless, raise $700 million selling it to people who don't think it's, and quote within the quote, don't think it's a fair reading into the language that's too tightly, unquote. So why bother to scam anyone?" The idea here is that there's a disclosure, which is the letter of the law, what you're supposed to do, that something's a dumb idea. People do it anyway, and they lose tons of money. And so this, before we started recording here, Don mentioned that one of the precepts of the code, which is a little bit silly, is try and ensure, however you want to do that the work product isn't used for the wrong purposes. Don, what do you think about this situation?
Oh, Lord. My wife is an actuary, too, and she... when I have talked to her about, I tend to be the risk-seeking member of the home investment committee, if you will, and she says, I'll authorize investment in some of these cryptocurrencies or digital currencies when you can explain them to me, and so I failed that test thus far. Look, Bitcoin, Ethereum, there's several others. I mean, there's new ones coming out all the time. You have to remember the original design and intent of Bitcoin was for bankless currency, right? So by definition, it was designed to exist in a distributed manner, right? Who was it built by? It was built by hackers, okay? And I mean that in a positive sense. I mean, it was built by heavily expert computer people with essentially, and very ironically, to protect themselves from themselves, right? So we're trying to design something that we can't hack. You've already seen several forks, they call them, in the history, maybe not of Bitcoin, but I know of Ethereum. You've seen eliminated.
People want to change some part of the algorithm, and so they make a change and they issue a new currency. And these would be examples of that, I suppose. People saying, hey, this is useless, worth nothing, you shouldn't buy it, and then people buy it anyway.
It's crazy. Look, there's and then I subscribe to the Fortune magazine. I think has a digital newsletter, and they said once quantum computing has not been figured out yet because Bitcoin still has value. That's exactly the quote from them. They said once someone really builds a quantum computer, all
crypto's out the door.
Right. They will solve these problems instantaneously that now take all this time and effort by them. I mean, so Bitcoin in and of itself, I don't, it's the tulip mania or whatever. It's a very hairy area right now. But this notion of these tokens. So I'm also involved with some of these other entities operating in this space, and some of them have. So do you know what an ICO is? That's an initial coin offering.
Right. Yeah.
Right. And I've read a few of these, and I just can't figure it out. So in terms
I think that's where this quote might come from. Is one of those where they say in the coin offering, because one of the things that intrigued me about this, at least in the context of this kind of conversation or analysis in light of the precepts, is they're doing the right thing, which is saying don't buy it. People are buying it anyway, So let's say an actuary to write that, right? So what duty of care do you have to people? Is a warning enough? The warning label saying, so let's say you're writing an issue an actuarial opinion saying, don't use this for pricing purposes. I don't know how many times you've seen this, right? Where suddenly it winds up in a pricing report saying, oh, the loss ratio is 65, where our pricing is adequate. It's like, well, it's a different question, and the actuary told you it doesn't matter. Gets used anyway, blows up a company. Did you do the right thing?
Oh man, I mean, this is in terms of this. Something like this example, and I know we're going to talk some about this later. This one's a qualifications issue, but actuaries are, we're at a professional crossroads because we want to expand beyond, my two terms on the board. We want to expand beyond the traditional realms, right? We don't want to be seen as rate making and reserving only. But what was our training in? Our training was largely in rate making and reserving, financial reporting. So you get into this issue of like, I have the best grounding. They typically really do. You know, insurance companies are complex. You're saying we want to move into a new area. So let's say, for example, a company was saying and many actuaries advise the investment committee, right? And somebody goes, well, what do you think about crypto? You know, how much should we invest in cryptocurrency? Right. How much should we be investing in, call it like NASDAQ type firms, tech, any of these areas? Now you're a CFA, right? And some CAS members or some actuaries also are CFAs, but that's short of being a CFA. I would have real issue around, trying to say like, yeah, I'm qualified to.
Well, and you mentioned before that some of these precepts are a little bit loose, and specifically the one that I'm thinking about and what you're saying there is annotation 2.2 to precept 2, I guess, is the absence of an applicable qualification standard for a particular type of assignment for the jurisdictions in which the actuary renders services does not relieve the actuary of the responsibility to perform such services only when qualified to do so in accordance with this precept. And so it's self-referential because it says according to this precept, just defining how to use it. So, I mean, you can interpret that loosely, and suddenly you're allowed to promulgate opinions on Bitcoin, and off everybody goes.
Yeah. Well, and also being hungry for new lines of business. I think I even saw recently a carrier, I'm drawing a blank, but I think there are some companies contemplating insuring, because this is an asset, right? Mm-hmm. It's an insurable interest,
sure.
Right?
You can put it on your balance
it's volatile. Right, it's volatile.
Yeah.
So, whether it's a derivative or insurance, it's unclear. But
hey, I can fit a log normal distribution to that sucker, like anybody else.
Exactly. But now you're getting into, that's a slippery slope in general.
It is, but aren't they all? And isn't that
I know. I know. Well, that's the problem, right?
Well, let's move on to the next one. So the next case study, the headline I have here is "What is advice?" And so I'm gonna read this out. This is another quote I think from a Matt Levine email. By the way, as a note to the audience, Matt Levine's amazing. I think one of the best writers alive today, and certainly in the financial media space. So he says, one problem with making banks charge for research is, what is research? So we talk from time to time on his email commentary, what is desk commentary, which is a thing where someone at a bank emails a client with a trade idea, but the person at the bank is not a research analyst, they're a trader, and so the trade idea is not a research report. We're feeling echoes here of what is an actuarial work product, right? So it's something an actuary does, but define an actuary, somebody who's got qualifications, you kind of get a bit circular. If you're in the business of regulating research, like U.S. regulators long have been, then you have to distinguish a salesperson selling a trade idea from a research analyst selling research. This is not necessarily easy, as the ultimate goal of both salespeople's emails and research analyst reports is, after all, to get the client to do trades. And in the early going, the MIFID's distinction, which is, I think, the European regulator, I think that's what that is, distinction might be a bit crude, and he quotes, solicitations from traders looking to pick up business from the buy side will drop significantly as regulations stipulate that all research must be paid for. Money managers are even taking steps to block emails from those firms that have been dropped from their broker lists. So that is, unless they are paying for their research, they're not allowed to have emails from people because then it's free research and that's against the law. So the comment from Matt Levine, closing comment, is, it's going to be weird when the only emails that money managers are allowed to receive are the ones that they pay for. Wow. So what is research? What is an actuarial work product? These definitional issues are really interesting.
Look, this is, speaking to the investment side, and growing my wife again. She can't get over Jim Cramer. Yeah. She can't believe Jim Cramer is still on CNBC. Well, that he's on CNBC because he's got a long track record of being investigated and allegedly using the CNBC platform to make the market move in a way that he benefits from positions. Now arguably he has to, and the most infamous was Wachovia, which, again, many people, that was basically, he brought the Wachovia CEO on or directly parroted his words saying, like, Wachovia only has $10 billion in bad loans when they had 50 and they were nearly insolvent. So people, propped it up for several more. So he's sort of the most, I'm not just picking on him, but I think the general idea here, question the source.
When you have a position of authority, it can be abused. And I suppose that's kind of the whole point of a lot of these precepts is use your authority wisely or responsibly.
Yeah. Look, the most valuable training I ever received was on propaganda and journalism in high school.
Really? Interesting.
Yeah. And propaganda is, it's all about what is not being said, how things, it's all about framing, it's about how you are presenting. I know we've had, kind of behavioral finance type presentations at actuarial conferences before about telling people, there's ways to frame the presentation of your actuarial work product to help or hinder, what you would consider to be responsible interpretation of it. It's things about like, are you framing it as here's this, but the downside scenario is this, or are you framing it as there's upside versus the average, that kind of thing.
And it brings up in my mind, like you could think that an aggressive response to that could be something like, well, that's not my control. And reasonable interpretation. I mean, who can I say? I don't know in my own mind what I think is the right way of listening to this. But no communicator is ever perfect, right? And so you wonder about what does one do if you're sitting there thinking, I got this real tricky little situation to navigate with the written word. You pull out your keyboard. How do you think about that? I mean, do you get advice from people? I suppose that's something you do. And if 3 or 4 actuaries get around and be like, yeah, we're satisfied with the precept here, we're okay. I mean, is that enough? Or, we're supposed to monitor what people, people are, what's inside their heads. You can't do that.
So I hear a lot, my current focus is being a lot in the call it the disruption and insurtech, the impact of digital is the way I like to really summarize the impact of digital on our business. And you have a lot of technical startup companies that need insurance knowledge and advice. So actuarial consultancies and things like the Big Fours are getting pulled in on it. The term I've heard repeatedly from a lot of them is independence. So, for example, they don't want to get paid using the way a lot of advisors get paid for these firms, which is equity, right? Or stock options, right? Because therefore now I have an incentive. But drawing on this example,
you mean the employees or who's getting paid?
The consultant.
Oh, the
right?
consultant.
So the consultant is saying, I'm supposed to provide independent advice and therefore not have a conflict for other such. Let's say I'm helping, pick a simple example, ride-sharing company A, and then I want to work with ride-sharing company B. Well, maybe small ride-sharing startup paid me in equity or stock options. Now I have I'm now conflicted, but there's a
There is. I'm just looking for it right now.
Oh yeah, no, that's the conflicts of interest one. I can look it up while I'm here. Yeah, that was number 7. Number 7. Right. So, precept 7: you cannot knowingly provide actuarial services involving an actual or potential conflict of interest unless, now get ready, A, my ability to act fairly is unimpaired, and I believe that is self-declared, right? It's like, I declare that I'm unimpaired. B, I've disclosed it, which is arguably right up the alley of what Matt Levine was talking about here. It's like, hey, you paid me for this, therefore it's independent or unbiased. And then C, everyone agrees that it's okay, right? So this is, again, sort of a self-fulfilling kind of thing, like, hey, I think I'm independent, and I told you, and you agreed. So that's what it takes for me to avoid it.
Well, I'm going to skip ahead actually, because one of the cases I have is, I just found this to be so interesting. So this is, what's the source? I forget what the actual original source is for this article, but it says I pulled it from, I think it might from some kind of law blog or something. Funny term, law blog. Disclosure is often, so the idea here is what is conflict and when is it okay to violate, and how can you immunize communication from conflict of interest? And the upshot here is you can't. So disclosure is often proposed as a solution to conflicts of interest, but research finds, and there's some references here as well, which the listener can look up themselves. Research finds that disclosure is often ineffective. Research on anchoring bias specifically, so Common and Swirsky, suggests that once bad advice is let out of the bag, its impact on judgment is difficult to undo. Indeed, the disclosure may even have perverse effects and can sometimes make matters worse. For example, disclosures can make advisors feel free to give worse, i.e. more biased advice, because you say, I disclosed it, and now you can really go for it instead of self-policing, saying you've been warned. Also, disclosure can pressure advisees into satisfying the advisor's disclosed interests because these interests are now common knowledge and are begging to be satisfied, just as a panhandler puts pressure on passersby to donate. How about that? Disclosure does not.
Unbelievable. Yeah. Well,
it does make sense, though. I definitely get it. You feel, so I'm in the sales business as well, and one of the things you always want to try and create is sort of this, shared mission to let's do something together, right? And you have to try and use that power responsibly, I suppose. But I mean, It's powerful stuff. Bias.
Yeah. No. So here's I thought about this when you sent me this stuff earlier. So here's one, right? We have a duty to the public as actuaries, which I believe is really core. I think we really filter
Protecting somebody who doesn't understand themselves what you're doing. Yep.
Well, we really filter people into this profession that I have found a highly common thread is this I call it like a mission-driven sort of thing. We really are. We really
believe
are.
it.
We're not just tooting our own horns, but we are really trying to be the gatekeepers, the protectors. So the duty to the public, right?
Yep.
I have to do a reserve opinion in talking about anchoring, right? How do I serve the aggregate best interests of the public best? If I use a very conservative reserve opinion and I put a very telling anchoring bogey out there about reserves position, and they get downgraded or on watch or notice from AM Best, and if it's a commercial carrier, they start getting adversely selected / their business starts dropping off, and it could arguably create a death spiral. So I have, this is all about like a local service of the mission versus think more sort of globally or in aggregate or over time. I have arguably, and I think we have to face this as actuaries, I had a contributory, we call ourselves actuarial scientists, but it's almost like, what is it, Heisenberg uncertainty principle, the act of sort of
measuring it changes
right.
its
So we are making, we make a claim. So I think about as an example the home insurance. That was back, I know many of your listeners won't remember that one, but that was one where I got to see the runoff triangles from the home insurance between when it was kind of put on notice or whatever. I mean, that was an extreme one because that was going into receivership. Mm-hmm. When you see that the loss development triangles, go out the window. I mean, the idea of any sort of it's like a regime change. The inflood of claims, and just so again, I say, well, that's an extreme. Oh, sure. So think about an impairment.
Where was that coming from? Where were those claims coming from?
That's like run on the bank. I mean, that's
Get
that's
your money out.
These aren't new types or whatever claims. It's that anybody that thinks they might have something. So many of them could have been, without merits, but it's like, hey, if you think you might have something on that one, get in there quickly. So look, I mean, the disclosing of this stuff, the disclosing of conflicts, I think in general, this notion of independence, and, I don't want to have any ties to these, small companies that maybe that's the way they pay things. I don't know. The whole notion of saying, and it maybe ties back to your earlier one about you can only take advice that you paid for, is, doesn't that presuppose, therefore, paying equals unbiased, right? Well, I paid for this advice. Because, you're producing actuarial work product for a principal, the argument being, or the assumption being, I'm now being paid, right? You have hired me as an actuary. So, and then somehow magically that now creates independence and unbiased and whatever. I don't know. I don't see it. I've struggled a lot with that independence piece in this space.
What's the right answer? Like what's a constructive? It's easy. I mean, it's always it's easy to say, well, this is silly. I'm not sure. As you're talking, I'm just thinking to myself, like, what do you do?
Well, here's what Jim Cramer now does. Just to use Jim Cramer.
Yeah, sure.
Any stock that Jim Cramer talks about on CNBC now, he puts in his blind charitable trust. He does not manage, or his blind charitable trust will take a position in or whatever if he were to take a position. So he has now said is I am not. No one's going to pretend that if I come and tell you that Intel is in trouble or Intel is doing great or whatever, that you're going to somehow believe that I, as Jim Cramer, am not going to also try to take advantage of that information. Okay, let's not pretend that I'm that independent. I don't believe. I think it's unrealistic to think like we're going to be literally so unbiased and impartial and objective that we're like, nope, I can't be affected by anything. Cramer does is says, now when I benefit from this knowledge of what I'm telling you, the benefits of that go to charity.
Right.
So it's a compromise in place of, and if you ever watch any CNBC shows, I'm not hawking them, but I happen to think like they've got some really great and instructive shows on there, the person talking, and next to them comes the list now. It's all up there. So that's disclosure, but I'll tell you, they're very compelling speakers. They're very sharp.
Charismatic.
Right?
Yeah.
So,
smart.
it's right. So you're watching, and so-and-so's telling you about this or that great stock, and you're supposed to, again, this is like back to these acknowledged mental weaknesses we all have from the behavioral finance research, right? Is we can't process multiple things like that, right? We're picking up sentiment from this person, yet I'm supposed to scientifically
the old lizard
it's
brain
like I know
saying,
my
buy.
exactly,
Whatever you're
right.
saying, do it.
Right, and it's like, oh, wait a minute, this guy owns this stock, and I shouldn't be listening, right? I mean, it's like
or another subtle things about financial markets is the guy owns the stock. He's a smart guy. I should own the stock too. But wait a minute, what price did he buy the stock for? It's not necessarily a good buy right now. So it's a whole other layer of kind of the social feedback on it. It's hard for the average brain to.
So if you think Fast Money is my favorite show, the light turned on for me when I watched at 5 o'clock every night on CNBC. If you think you want to become a day trader, if you think you want to take on your own investment
that's who you're up
responsibility,
against.
watch Fast Money. I believe one episode you'll be cured of that delusion because you realize, wow, these are just people cut from a different cloth regarding, and again, I'm not questioning, it's not about an intelligence thing, it's about they have a predisposition.
Oh, they care.
In
a way that you're not going to care.
You have to process so much information
if they want it. I'm thinking so what's the opposite of biased? And I'm wondering whether, I don't know that unbiased, maybe unbiased is something that, maybe what we're talking about here is it doesn't really exist. So maybe the opposite of bias is ignorance. So I'm so unbiased about Intel. I know nothing about Intel. It's like, well, why are you giving me advice on Intel? It's almost like by through the knowledge, they're necessarily going to form an opinion. And can you, in opinions, even your own mind change over time? So are you going to have the same opinion now, or sometimes I'll be making a point or even a presentation, and I might change my mind while I'm giving the presentation, and then after I'm thinking about it, like, boy, actually, I don't believe that anymore. I believe something else. The argument didn't go as well as I wanted it to, and you change your mind, and now you're going to make a trade, and suddenly it's like, well, you're biased. Like, well, if you could see into my mind, you could see that what I was doing wasn't wrong. It's like, forget it, peering into the mind of a podcast host. Okay, so next case. Yep. So brokers enabling predation. That's funny.
Sure.
Is my own label. We'll see what I meant by that. Brokers who tell clients that this is interesting. A large position is being liquidated. So this would be a stockbroker in this case.
Yep.
So they go to a client. They say, boy, I have a client over here who's going to sell a ton of X asset. So it sounds bad because obviously you're going to move the price by saying there's a huge amount of inventory that's available, and so the price, the buyer or the person your counterparty you're trying to pitch to knows the price is about to go down. So they can just say, yeah, okay, so here's my price, and wait back, manipulate the market that way. So is the broker guilty? And there's an ambiguity here because obviously, on the one hand, the broker is signaling a huge amount of volume. That's not a good signal. But on the other hand, how else are they supposed to know where they can get a buyer? Because they have to say there's a lot of volume in order to sell a lot of volume. But by saying that, they're manipulating the marketplace.
Yep.
What do you think about that?
Oh, boy.
What disclosure? I don't know what precept that might hit.
So I had the good fortune working at Center Re, and at the time, Frank Pearson was chief actuary, and a guy named David Brown was chairman. And I remember David Brown and Frank in a discussion, and David said, actuaries make terrible underwriters, okay? Because actuaries are concerned with the right price, and underwriters are concerned with how much is the customer willing to pay. I think that's the contextual thinking that actuaries really struggle with. It's almost a game theory kind of thing. It's like, look, give me the context. So it brings you to this question of I think the precepts, again, to me, sometimes read a little laboratory, like in an idealized world, right, where there are, again, objective and well-informed and equal parties of equal capability, capacity. It's almost like, commercial transactions versus ones where there's considered to be information asymmetry. I feel like the precepts are, and I'm not advocating that they be expanded because that, they're already, there's enough going on already versus saying, well, but if there's context. I think this idea of saying, did this broker and this liquidation perform a was that a disservice to their customer? Because the
customer's going to get a worse price now, right?
But
because by customer signaling there's a big volume in the market, the broker goes to the market, says big volume coming, the market says, okay, price just dropped by 15%, and the customer's like, you screwed me. You know, the duty of the client gets violated.
That's Wall Street. I mean, that's the part of Wall Street that from my experience, has always made actuaries cringe and struggle. And again, I don't know if it's because we have this sort of idealistic, you could argue, bias or predisposition, you know, that we don't like this notion that the buyer and seller in Wall Street are humans, right? And these are people who are hardwired. Remember, we mentioned earlier, question the incentives. They're hardwired this way. I want to sell X. Why? Right? Versus, again, actuaries would go, I want to sell X. We're much more what you would call fundamental analysts. In the stock market world, we're about, where's the objective data? Give me the models. We all have, it's a level playing field, right? We all have equal access to the objective data. You know, and I know that we know that's true.
Yeah,
again,
sure.
like in a laboratory setting, but yeah, exactly. But not in the
air quotes.
Right. It gets messy quickly. But I think this idea of saying, so possibly, right, you would say, applying the actuarial precepts lens to this broker. You would say, arguably, that an actuary would say, listen, if we go out and try to liquidate this large thing now, and in a short time frame, right, price will hit, right? You'll take a price hit. So, right, therefore, right, split it up. And again, I think this is
or you know, like there's two ideas here that have popped in my head. One is, in order to fix that problem, you have to mislead people, right? So you have to say, you know, there's precept 11, not engage in advertising or business that actually knows are false and misleading, right? So that's against the rules. But so now you're violating duty to the client, or you're lying to people, or you know, you're kind of like playing this little shell game, like, well, there's only half the size of the order, but you know, it's actually bigger than that. And so, you know, who do you mislead is one part of it. The other thing that was interesting that came to mind there was the story you told a minute ago about home insurance company, where once you put them into runoff, the whole thing blew up, right? So more claims come out. So to a certain extent, there is a kind of a confidence game going on everywhere. And as soon as people lose confidence, and so if you now knowingly, so you now have that information in your head, you understand. Don Mango understands that if he issues a bad reserve opinion for a company, he might make the problem at the company worse. Where's the duty there? I mean, I don't know. So that means, like, you know, the policyholders might not get their claims paid as a result, right? Because there might not be any money. They might be last in line for the old run on the bank, and there's nothing there. You know, I don't know what you do about that.
Yeah, I think the
circularity is hard to even think about.
It's I'm a science fiction fan, and so it reminds me of the laws of robotics of Asimov, where they can be in conflict, but if you put a priority on them,
there's a hierarchy.
Then that's how you resolve. So I think we have a.
Is there a hierarchy somewhere here?
I don't know.
They're numbered, which does imply a hierarchy. Right?
I don't think that's. I don't know, but yeah, that would be the right again.
I mean, precept 1 does seem pretty universal, right? An actuary shall act honestly with integrity and competence in a manner to fulfill the profession's responsibility to the public and uphold. Well, here's a funny one: the reputation of the actuarial profession, and you know. So what? So once you reputation, it's like, well, I mean, you know, I don't know how many different reputations you have, but I got a bunch depending on who you ask. You know, maybe I've ruined my reputation by accident here and there at some point.
Well, do you remember the S&P, the infamous S&P debacle back in, was that 2004?
You'll have to remind me.
Oh, that was after the period of, so 97 to 99 was sort of the height of or the depth of one of the softest casualty markets probably we've ever had.
Yep.
And then 2000 through 2003 and 4 that's what Dave Clark likes to say. I think there was more reserve hits in that stretch than there were Nat Cats in the prior 10 or 15 years. Everybody's talking about cat.
It's casualty.
It's casualty, and we just destroyed more capital. S&P put out a scathing report that essentially said, where's the actuarial profession's accountability?
Ouch.
How are these? Yeah. And it was, you know, I, again, was involved with the CAS leadership at the time, and that was a delicate reputation. We had the academy involved because it was it was a delicate response that was needed, and in my opinion, we kind of didn't do our reputation. We could have done better had we engaged, you know, with a real kind of PR firm. But the question I would say to everybody is, what do you think our reputation is? Because I know, I mean, you've heard over time, and you see it now. Again, maybe I'm overly exposed to kind of new things or new lines of business. But take something like cyber, okay? Well, take some of these lines where there's just never been much actuarial involvement. Property, marine, aviation, whatever. There's some actuarial work, but it's not there. Frankly,
old school, they say.
Right. Well, they say it's old school, but you have to get back to what's been the reputation of the actuarial profession regarding the needs of the business, right? Which is, let's say, to operate with less loss history than you like, with non-stationarity of conditions.
Sure.
Aviation is
classic.
It's straight right. It's a very binary, or it's a highly volatile line, and you could make legit arguments to say
the engineering is changing. Safety standards are changing. Airline deaths have dropped. Blah blah blah. Yeah, non-stationary. Yeah, sure.
So, what's our reputation been in that space, and are we therefore, by sticking hard line to that, limiting our future prospects? Right? Do you want to think about it as, and we've had a lot of. This is a common debate among actuarial society members when you really get into it. Is there's a lot of membership that want to be deep, right? We want to be deep experts in. They're okay with what are called the traditional areas versus call it, little less deep depth, but more breadth, right? So bigger impact, arguably lower impact over a broader footprint versus deep impact in a narrow footprint. Look, it's 6 of one, half a dozen of the other, I know, but that to me is where the reputation part becomes an issue, because you're going to say put an actuary in underwriting. How many actuaries do you know that are underwriting?
Yeah,
right?
sure.
A lot of them. I know one. I know several in reinsurance who have business cards with no letters.
Yeah. Oh, totally. Oh,
right?
totally.
It's like, here I am. I'm Joe Smith or Sally Jones.
Yes.
You don't mention everybody. Oh, by the way, I'm an actuary.
Yep.
Because
that's a great point. Actually, I hadn't even thought of that so much as because I have my letters and I have them on my email. Even though the actuarial profession, I'm a supervisor of actuaries and all that day-to-day work. Who knows, right? But as a colleague of mine who's also progressed kind of beyond a bit more than me, away from the actuarial kind of day-to-day work, who's talked about losing letters just because he's like, it biases the conversation. It makes people think of me in a certain way, and I don't know if he'd characterize it as negative, positive, but maybe just sort of different, and it's interesting to think of when do you want people to know you're an actuary, and when you are okay with them just thinking you're not, or implying based on whatever else people do, look at you, I guess, see how you're dressing. I don't know. I hadn't thought of the way that I was thinking of the reputation of the profession is when you have kind of a public, some kind of public individual who's screwed something up but hasn't done anything wrong within the profession, right? So you've applied everything properly, but it just went wrong, and then suddenly it blows up. And I have another example, which I think this is hilarious. Okay. I don't know if you read this one in advance, but so this is a judge applying economic logic. So there's this Michael Dell. So Dell took his company private again and was sued by his shareholders because the buyout price was too low, according to what they said. And a judge agreed with him, agreed with the shareholders, rather. So the first judge agreed with the buyout. So the price at the stock was, call it $12. Michael Dell bought it out for $13.75. The price was $9.35. Michael Dell bought it out for $13.75, which is a massive premium, right? It's like a 40% premium.
Yeah.
And then was sued for it being too low, and the judge said, yes, it should have been something like 17. Which is amazing.
Based on,
so the judge went through this cash flow model, which he built himself, I guess, according to some precedent. So there's some legal precedent of here's how you value companies, and so they applied the precedent to this case, and that's what judges and lawyers do, right? So where's legal precedent? We'll just take that, we'll apply it to this case, and then there's your answer, and that's what law is. And what's one thing that's interesting about that is, it's so stupid because and here's comes to a deep issue, which we touched on earlier, is that prices are a market phenomenon, right? So the point we were saying about what can the client bear as opposed to what's the price. There is no right price in any market economy. The right price, and I'm revealing my colors here as kind of a EMH sort of economics guy, but the market will tell you what the right price is. And so people make the point sometimes in my business, reinsurance broking, where they say, well, the cost of capital is this or that. And I always get a little bit frustrated because I think the cost of capital is an output of the process. It says we observe the cost of capital is because the market tells you what your capital is worth. And you can give some back if you're not happy with that, but you're not going to dictate to the market what the cost of capital is. It's something that comes out of the process. And so the judge saying, here's what the right price is, well, the judge could very well have put a bid in if he wanted to and tried to move the prices himself, but that's not how this works. What do you think?
That's crazy. Look. Wow, we've had, so again, you probably, I don't know how many folks know what happened. So maybe I'm tying a bit back to the reputational, but we as a profession get lumped together. Okay, we all like to think that pension, life, health, P&C, they're so separate and distinct, and everyone knows the differences, and yada yada. True, I would say within our, again, fairly opaque industry, right? Which it is to people outside our industry, fairly opaque. Most people, actuaries, lumped together. Okay, just is what it is, right? Kind of like engineers. Again, engineers like to say, mechanical, electrical, civil, chemical, great, And again, to the companies hiring them and whatever, absolutely clearly know the difference. Most people in non-insurance companies know actuaries to be pension actuaries.
Yeah.
Because every company that's of a certain size has pensions, they know pension actuaries. We all probably don't know, and you can go look it up, whatever. The pension profession, it was in the New York Times. I mean, the pension profession.
Yeah, they're pretty have trouble, don't they?
Pension actuarial profession.
Pensions are in bad shape.
Put our profession and reputation at serious risk. And it was along the lines, so give me a second, I'll tell you, along the lines of this judge kind of acting outside of really what I would call like core expertise, or probably more so not bringing in, like if I was, to this judge, the way this really should have been done is you should have said, let's bring an independent valuation firm in, like Mira or Alvarez Marcel or somebody that can really do true valuation work. It's almost like getting an appraisal, right? So-and-so thinks my house is not worth whatever. I say, great, let's get an independent appraiser. And that's how the judge should have done it. The pension actuaries, and I'm doing a simplified version, and you want to get because the details get a little tricky, but there were issues around not using, and you're an economist, not using market consistent economic variables and interest rate assumptions and so on, using more it was almost like using current market yields versus embedded. I'm not doing it justice, but essentially this is what led to
they make assumptions about what the returns are going to be, and
But it was not done in a manner that Wall Street, and essentially what happened, I think similar things were happening with the variable annuity books that had issues, right? It was that you had actuaries, again, you got to be honest about our biases and tendencies, right? We bring a lot of smart people into the profession, and many of them tend to start with their own wherewithal when solving a problem.
Yep.
Rather than saying, wow, this is, a variable annuity with embedded guarantees tied to the stock market, maybe Morgan Stanley. Let's call Morgan Stanley, right? Yeah, exactly.
So you open up a new spreadsheet.
Outside of my, right, instead of going, well, I know how to do that, I know how to put the Black-Scholes formula into data. It's like, similar to, you mentioned cost of capital. I mean, there was a famous paper by Myers and Reed that came out many years ago about cost of capital, where they were applying, essentially an internal Black-Scholes model to value the inherent the assumed put option that each segment of the business has on required capital. I mean, again, I'm simplifying it here, or whatever, or again, not giving it full treatment it deserves, but essentially, Black-Scholes is built upon an efficient market, right? The formula looks like we can understand it and use it, right?
Yep.
It's sort of like, it's a log normal and it's a put and da-da-da, and it's like, okay, whoa, in order to arrive at that formula, there's all these assumptions about the marketplace in which Black and Scholes came up with that formula, and you're now talking about applying it inside a company when it's not even a market for assumed risk capital, et cetera. I mean, look, they were trying to do something to provide clarity around regulatory frameworks who said we need cost of capital so we can assess rate adequacy. I know you're mentioning it, and I'm sure that part must drive you nuts when you hear about regulators saying, you're earning too much, right? How do I determine that your rates are not excessive? Well, I need to know your cost to capital, right? What are you earning in
and you
writing
back up
this
the truck
business?
with this colossal model, right? And at the bottom of it somewhere is this little thing that says, the market required return is like 8%. It's like, well, where'd that come from? Because that's the whole point, right? And you're making some huge assumption with colossal implications. And where does it come from? Well, I'm not sure.
Well, just to make an advertisement for some work we did at Guy Carpenter that was very well received in the industry. There were ERM teams in large insurers in particular who were evaluating reinsurance effectiveness to, our world here, David, with reinsurance broking, right? They evaluate reinsurance effectiveness. One key metric they use is ceded cost of capital, right? The formula, the method they were using for ceded cost of capital was essentially run the capital model with and without the reinsurance program that we're considering, right? So you run the whole thing with and then without, and taking some remote tail metric like whatever, the 99.5th percentile for net income, right? Like almost Solvency II type number, and go, our required capital went from whatever, $1 billion to $950 million, so therefore, right, the ceded capital was $50 million, right? But to your point before, of course, the key other missing element was, and what's the cost of that capital, right? Because there's $50 million of savings, right, times some number equals the reinsurance is worth buying versus not worth buying. And we would have companies say to us, well, what should we use for cost of capital?
Yeah,
we
sure.
were like, well,
that's your job.
You should know. It's like, that's your key decision variable, and you're kind of pulling that thing out of. So we did some work to try to introduce a more, think of it more like a debt approach. I know you mentioned the debt world earlier or whatever. We called it capital tranching, but the idea was to say, look, because essentially the other approach just treats the capital as one giant block, and it's a last-in kind of measurement. And we said, look, if you debt financed your capital needs, if you will, then reinsurance. So, a side effect of that current approach was anything except a big corporate cat treaty. Terrible. Looked terrible in the model. Because let's say you bought a quota share, a regional quota share, which many companies do, right?
Yep.
A working layer, right? Hey, I got a working layer program. It's not meant to protect aggregate risk capital of the company. It's protect underwriting results for one division or whatever it is, right? So when I put that treaty, that poor little treaty in the monstrosity of the company, again, if we're a large company, you're going to see almost no effect out in the tail. Therefore, according to this model, not worth buying.
What's amazing about that to me is that so much of the effect of the answer depends on what the question is that you're asking, right? And so you have somebody asking you the wrong question. And I wonder, because they say to you, they're like,
it's your responsibility.
Yeah, that's exactly right, right? Yeah. So what is your responsibility, right? So, you were doing the capital modeling work at Carpenter, and you go to a client, they're like, we got some time with Don, he's going to come out, he's a good guy, and he knows what he's talking about, and he's really smart, understands all this capital stuff. Like, cool, he can answer my reinsurance questions, and he asks you the wrong question because you're there, and now you say what? You don't sit there and say, dumb question, got to leave now, sorry. Which precept matters here? Let's think about precepts.
Oh man, again. Yeah, I mean I'm not even sure is that one in there, but it's.
It must have to do something to do with having the client understand properly what it is that you're telling them.
Like really well run consultancies that I've worked with, whatever, and brokers struggle with this because of the idea of value-added services, which means they don't have these required discipline. Well-run consultancies spend a lot of time. It's almost like anybody that's worked in predictive modeling will tell you, you spend the majority of the time on data prep, right?
Yeah, right.
So consultancies will tell you the most important part of the project is getting the scope really clearly, well spelled out and defined, and that really starts from not the client saying, I want you to do A, B, and C, but you saying, what are you trying to achieve, right? Which I think has to be embedded in these. That's almost maybe precept one caliber, sort of like, your job is not to, and I'm being excessive here in the statement, but your job is not to generate billable hours, right?
Yeah, right.
Because the client could go, I want you to study all these, in-depth stuff, and you thinking, well, most of that's not going to be worth doing, but wow, we can really rack up the. Now, to me, that's also a one-and-done kind of project. I think, again, well-run consultant, not just picking on consultants or whatever, but well-run consultants recognize this is about, and I know brokers are the same way, you want this to be about the annuity, if you will, right? We want this to be about, hey, I helped you, I got you the answer to your real problem with, a $10,000 project when your version was $100,000, which, incentives-wise seems, right? I cost my company, my consultancy, arguably in the short term, but I think everybody recognizes that's talk about reputation. You're now saying is we will put your needs before our own short term, because it's a mercenary move, right? You're going to go for these, like, I'm going to try to grab that $100,000 project now. No, And
And
especially,
what's
you know they're
interesting
not
about
going to be happy.
You know they're going to be happy at the time, but at the time they might not realize it, right? So they go along with it, and so they're saying, "Oh, good idea, let's do that. Oh, that looks like fun. This is cool." And you can promise them, all kinds of rainbows and sunshine and stuff. It doesn't quite work out the way they think, and then you could have anticipated it, but I mean, you could have anticipated it, or maybe you could have but didn't, or who can see into the mind of somebody else? Like, how could you judge somebody else? Yeah, I'm thinking that maybe precept 8 may be applicable here. So actuary performs actual services, so take reasonable steps to ensure that they're not used to mislead other parties. And, but again, thinking that, so let's say you get asked this question, wrong question, right? You feel uncomfortable pushing back in the meeting and saying, that's a dumb question, to the CEO of your client, and your boss is in the room, and everybody's like looking at you with, beady eyes saying, you're going to answer this question, right? And you're like, yeah, I'll answer the question. And then out comes the report, and it's got this massive disclaimer on it, so it should not be used to decide and make a decision on buying this treaty. And the guy goes ballistic, and you say, well, the precept told me I couldn't do this. And then they're like, yeah, you're fired.
Yeah, oh, man.
Difficult position.
It's tough.
Difficult position. That kind of communication is hard. I mean, what do you actually do? When I think about what I would do, I would probably talk to my boss, and I'd probably say, that's a dumb question, man. And here's kind of why I'm thinking, what do you think we should do? And hopefully you can trust in the culture of your firm to actually understand that the right thing to do is the right thing to do, whether it's in the precepts or not, right? And you want to make sure the clients can come out of this thing with the right decision.
Yeah, look, a great, I know you and I both were, in sales type roles, a really great essential skill in the sales space is the ability to help somebody save face.
Yeah.
Right.
Yes.
In that setting and whatever. Right. It's about not and it's delicate. So let's say, for example, you're there helping to pitch in an open RFP on something like reserve work, right, or in the broking space, right. You can't go in there and say to the panel of people making the decision, your current reserve review work is substandard, and I mean, you can't shoot that incumbent too badly, because the person the people on the panel, there could be somebody there who has said, we've been using firm A for 10 years, I love firm A, I put my reputation on the line. Yeah. So it's this notion of walking that fine line of saying, find a way to say, like, hey, it's good, but it's good, but we've got better, or there's many parts of it that are strong, but right, maybe some fresh eyes, et cetera.
Well, think about those pension actuaries again, right? So what's really going on there? Like, what I think is really going on there is they've got clients, right, and they're applying this, which is amusing because it's the title of the podcast, the not unreasonable standard, right? And it is kind of a joke, because it is kind of a joke. It's a silly standard to apply. Not that I have a better idea,
right.
But so the pension actuaries are saying, we think this ain't right. We're not sure what the tipping point is here, where it's so wrong that it's going to be catastrophic. So we're just going to carry on doing what we're doing, and I'll just sort of grit our teeth a bit, and boy, do I hope that I retire before this thing blows up in our face. Because the clients need it to be this answer. Real bad. Real bad. I mean, there's a capture there, right? There's sort of, almost a pseudo-regulatory capture. And so thinking back how maybe one of the things I was doing as I was prepping for this is thinking about where and in what ways do the precepts might they conflict. And maybe there's a potential conflict here between the reputational issue and this idea of misleading or doing work which is not, like biased in some way, right? So what's the reputation if you're an actuarial firm and you speak truth to power in a way that's inappropriate or wrong or premature, right? So you apply a standard more aggressively than the next guy might, and you blow things up, and suddenly, this stupid dork actuary, doesn't understand how the real world works, and he's just touched in his model, and it's wrong. And that's a reputationally damaging thing, and then that's part of the reputation of actuaries, right? That we trust our spreadsheets, not necessarily whether the social considerations of things or something like that. I think maybe those pension actuaries do present the biggest moral dilemma of decades.
Yeah. Well, look, I think we've been mentioning a lot of behavioral finance stuff. I think everybody needs to read up on that in light of these, because so I thought of a great quote from a great article that Colin Powell, a former Secretary of Defense, wrote, and they were talking about there's a lot of what I would call actuarial counterparts in other types of organizations and companies, not insurers, right? And one is in the intelligence gathering community supporting the military, okay? Believe me, these folks are in the same the dilemmas that we get into, right? Which is they don't have perfect, we all think like, well, the drone must have taken live video of, this person we're trying to find, and there they are, and we know exactly where they're wrong. They have statistical type information. They have tendencies and patterns and predictive modeling and all this stuff, right? So Colin Powell used to say, look, real decision makers need people that can help you when there's between 40 and 70%, he's using rough terms. Think of it as between 40 and 70% of the information has been kind of revealed, right? Obviously, we'd all love to wait for 100. And I think this is, again, one of these sort of biases or tendencies we got to work with as actuaries. We tend to respond to business leaders by sort of saying like, oh, not enough yet, not enough yet, whatever. And we're not saying go out on a limb, whatever. So another model from a guy, Andreas Durig, who was a great colleague at Guy Carpenter, great actuary, European actuary. He worked in a lot of those funky lines of business where actuaries don't generally work. Surety, aviation.
Sure, aviation,
right? Okay?
marine. Yeah.
Right? And he came up with this great phrase that he used to use, because he didn't have the luxury. He would often tell us, I don't have an RMS or an AIR model in my world. Okay, I don't have the catastrophe modeling. Okay? But he knew what the brokers, he knew what the underwriters, he knew what the reinsurers needed. He said, what needs to be true in order for this to kind of be something? And I've heard that exact phrase from private equity and venture capital people in this insurtech and startup world. You know what I'm saying? So maybe that's a mindset we can see if that can be responsibly fit and supported by precepts. It's a bit sort of the opposite direction. It's kind of like saying, can I, and we're not saying cook the books or come up with a false justification or whatever it is. It's saying, can you find, maybe you're not unreasonable standard. Can you find a not unreasonable, a standard you can live? What do you need to believe in order for this to be true? So in Andreas's case, he'd have a surety reinsurance program, and in order for the ceded cost to capital, right, where you don't have the luxury of the RMS model to give us the tail metrics and whatever, in order for this deal to be, a good value for the client, they need to only have claims bigger than X every, pick a number, whatever, 1 in 5 or 1 in 10 years.
Yep.
That's the kind of altering of our mindset that I think would make us, we got to find a way to be more business valuable, like Colin Powell would say, right? We can't afford to go like, I'm sorry, I'm going to fold my arms until I get, 90, 95, 100% of the data. Then they don't need us. And that's the other thing. When you want to talk disruption or whatever, we need to be very concerned with this artificial intelligence, machine learning, whatever. There's a non-trivial threat that a lot of the, call it traditional actuarial work, can be done to a reasonable level, increasingly in an automated fashion. Doesn't mean no actuaries will be involved, but it may mean that there's a lot fewer of them. And by the way, these models don't have a problem operating in this, space with less data.
So I want to close with one last observation, and this is just kind of, so what I have in front of me here is the text of the precepts, and by far the largest text character count is precept 10, which is entirely devoted to giving guidance on how actuaries should coexist. And it's an interesting kind of meta commentary, I think, on the profession, which is about, it's hard for these guys to work together, because you have this semi-competitive situation. And one of the key, I was just wondering if you have any experiences you can relate around this, where you bring in another actuary and then people start getting a bit chippy with each other, and you have a whole pile of the code. I mean, it might be, I don't know, a quarter of the text of the entire code of conduct has to do with just kind of play nice, guys.
Yeah. Well, right alongside that saving face, and again, sometimes the other actuarial party is the client's actuary, right? So you're working for an insurance company or a reinsurer, you're their own staff. You're coming in recommending something that's at odds with what they're. So these are absolutely critical skill. I'll give credit. This precept 10 is actually very business friendly. It's really saying that, look at annotation 2, the client has the right to pick.
Indisputable right.
Okay?
It's
right.
proper
It's
language.
Because maybe sometimes people, this is, you and I know from the broking world, it's like, hey, new person in charge or a new regime or just whatever, you could have done banner work for the last several years, and thanks a lot, shake hands, and moving on. Client controls the, right? You have a situation where the best, annotation 3, the best interest of the principal is served by setting out an opinion to the one expressed by the other actuary. So they're saying is, this is almost, by the way, giving you this kind of priority that we talked about between them. It's saying, okay, by the way, are you also therefore putting your engagement possibly at risk? Yeah, but now you're back to like, well, the best interests were served by me saying, I don't think these trend factors are, been involved in ones where it's, we get into this a lot. I know you guys do casualty. Property reinsurance doesn't have that much actuarial involvement, especially compared to casualty. Casualty is still heavily actuarial driven, heavy actuarial judgment, very tricky stuff. Large loss adjustment, right? Trend, excess loss development. Development of individual claims, very open,
and actuaries get it wrong all the time too.
Right? And the underwriters, how about re-underwriting? My favorite one. Re-underwriting, right? You look at the data, you sit with the client, they go, okay, we're not doing that business anymore. So you go, wow, well, without that, you're...
Yeah.
And they want you to go out, and you're like, well, I have to tell you, and this is a perfect case for us in the broking space, right? I always felt, and this is actually an interesting point, because brokers will hire actuaries from reinsurers, and I always think of that as, and I would always tell the new actuaries, that came in with this notion of like, I've got capital to protect, right? I come from Munich or Swiss or wherever. I got capital to protect, right? And it's the right mindset or whatever. And some have come in and said like, whoa, now I'm in the broking space, am I going to be asked to compromise my principles? Absolutely not. My assessment of the role, and see if you would agree, is you're there to be a mock jury. We're there to tell the client, okay, I understand you've re-underwritten this, professional lines or whatever book, right? And those claims they're not going to happen again, except, you're asking a reinsurer to take a big financial, risk on you, and probably they're not going to completely dismiss those, you know what I'm saying? Like you're telling me to dismiss them, but I don't know if that will happen.
And we put on the suit of armor, is the way I think of it, which, and specifically with these words, where we say, this is not my opinion, this is what I believe the reinsurers will do.
There you go.
Right? So what we're doing is we're kind of summoning the reinsurers to the room and saying, hey, I don't know, I think you're right, you're a genius, you know what you're doing, but the reinsurer is going to say this, and this is what they're going to believe, and this is what we think we can convince them is true. Yeah. And that's not the same thing as us saying it's not true, or we're not having an opinion here, but we're really transmitting what we think the market signal is going to be back to you about this book, and that helps a little bit.
It does. Stuff.
We're out of time, Don. So that's time.
Okay.
Thanks a lot for joining me. Yeah, that was great. We'll have to do it again.
There you go.